Hi, good morning, all of you. So let's start today's session. Today we are learning about transfer pricing. This is one of very important topic, very important for your exam point of view, and very interesting also. And you will see, like most of the topic in your material is theory, but this one is practical. I hope you will take interest in this because it is more practical. All right. Okay, let's start the topic. So the topic name is what? It is transfer pricing. All right, let's see what topic we will cover here. So we will cover transfer pricing and we will cover the various method of transfer pricing. Then we will study about the goal congruence. I'll prefer to cover these topic in today's session. We will have 3 sessions for this topic. So I'll prefer to cover these topic. And then you can see we have some decision-making topics. We will take the decision when we transfer the goods from one department to another department. And we have some topic on international transfer pricing also. Okay, so let's start the session. So the first point is that, ma'am, what is transfer pricing? What is transfer price? What is transfer price? What is transfer pricing? And how we will use it. So as if you remember, we have done a chapter where we have studied about the selling price. You know? And you remember I told you that finding the price of a good. You want to sell a good in the market, and to find out the price of a good is not an easy task. Right? We have to consider a lot of factors while deciding the selling price of a good when we want to sell a product in the market, right? Now here what is happening, here actually you are transferring the goods from one department to another department. So an organization can have various departments. Let us consider, for example, department or process 1, then department or process 2, then department or process 3, right? So what will happen? Maybe you are receiving the raw material here. You will receive the raw material here. All right. And the output that you will receive here will become the input for this process. Then what will happen? Further process will take place here. Then what will happen? The output of this will become input for this. Right? Then what will happen? You will receive a final good here. So this is how a good will pass through these departments. Product will pass through these 3 different departments, department 1, department 2, department 3. Now the question comes here, when you are transferring the goods from one department to another department, here what will happen? Various managers are sitting. Here various managers are sitting. And what will happen? If you remember, we have done process costing. If you remember, not in CA final, but must be in CA inter, you all have studied about process costing. So what happened in process costing, when your product passes through different department or different processes, what happened here? We find the costing for different processes. So what happened? You apply the process costing and you prepare a cost that will take in place, that will be happen in this process, in this department. Process, whatever the process taking place here, you find the cost here. Then you transfer the goods from here to here. That will be transfer price. So actually you consider the transfer price minus all the cost, and what will happen? You will find the profit of this department. This is how you find, and it all comes under process costing, where you are preparing the costing of department 1, right? How much cost they are taking place. But here what is happening? Actually you're trying to find out the profit for the process 1. Then what will happen? Whatever the raw material you are receiving is input for them, or it may be the cost for them. Whatever the raw material you are receiving in department 2 is input for them or it's a cost for them. And the price at which they will transfer the goods in department 3 will be transfer price. So transfer price minus cost will give again profit. Again, you will get a profit here. But this will be a profit of department 2. This will be what? It's a profit of department 2. Then after this, what will happen? You will transfer the goods from department 2 to department 3. That will be a cost here. And what is happening? You're selling the final good at the sale price, right? Again, you will have a profit here. Now, what will happen? Each of the manager of these department will try to maximize the profit of their respective department. Each of the manager in these department trying to maximize the profit of their respective department. Why? Why this manager is interested in profit of this department? Why this manager is interested in profit of this department? And why this manager is interested in profit of this department? The question comes here, why they are interested? Because on the basis of the profit of their respective department, they will get what? The appraisal, bonus. They will get the bonus. They will get the appraisal. So on the basis of the profit of their respective department, they will get the bonus or appraisal. So this is how the things is happening here. I mean, they are all focused on increasing the profitability of their respective department. Keep it in mind, because when we will study, I'll give you different cases, and in all the cases, you have to think about it. Actually, manager is interested in increasing the profitability of their respective department. You have to keep this line in your mind while you're taking the decision for the company. The manager is interested in the profitability of their respective department. All right. Okay. And what is happening here? But if you will see, there is a word of goal congruence. If you see, let me show you. You can see here, there is a word of goal congruence. Now the question comes here, what is the meaning of goal congruence? So goal congruence means though the manager of different department, they're interested in the profitability of their respective department, but goal congruence means before watching the profitability of the respective department, first see the profitability of entire organization. So what will happen here? We prepare two cost sheet. One cost sheet is for their respective department, and another cost sheet is a cost sheet for entire organization. So what happened in such cases, we will consider the selling price and we will consider the entire cost of all the departments, all the company. That will give the profit, and this will be the profit of entire organization. This is selling price, total cost, and the profit of entire organization. Now, the point is that goal congruence means the organization should first see the profitability of entire organization. Every manager should first prefer the profitability of entire organization. Then they should see the profitability of their respective department. Okay, so profitability of the respective department is important, but before watching the profitability of their respective department, they should first see the profitability of entire organization. So this is goal congruence. Goal congruence where all the managers are first interested in the profitability of entire organization. For example, Meena Verma is the owner of any organization. Meena Verma. This is CA Meena Verma. Now the point is that this is my organization. In my organization, there are different managers, those who are working. For example, Akash, Vikas, and Vilas. So these different people are working in the organization. I know I will I will encourage them to increase the profitability of their respective department. I'll encourage them to increase the profitability of their respective department, but I will also encourage them to increase the profitability of entire organization. And I will see first preference should be the organization. Matlab first preference you should give here. Sometimes these managers have to sacrifice their own profitability for the profitability of the entire organization. So you have to check. We will encourage them that, your first preference should be this, profitability of the entire organization. Then second preference should be the profitability of your respective department. And this is known as what? Goal congruence. Otherwise, what will happen? They keep on just watching, or they are just interested in the profitability of only their respective department. This may affect the profitability of entire organization. So first preference should be the profitability of entire organization, then the profitability of their respective department. This is known as goal congruence. All right. Okay. Now the question comes, what is transfer price, ma'am, here? So you can see these different departments are actually transferring the goods from one department to another department. They are actually transferring the goods from one department to another department. Now the question comes here, they're transferring the goods, right? Now the question comes here, at what price they will transfer the goods? What will be the price, at what price they are transferring the goods from one department to another department? This is the question. At what price they are transferring the goods from one department to another department, that will be transfer price. This is a question. Okay. At what price? Now, if you will see, we have different method at which they will follow to transfer their good from one department to another department, right? You can see here, if one is market based, matlab on the basis of market price, you're transferring the goods from one department to another department. And the second one is what? On the basis of whatever the variable cost or the total cost you're incurring, on the basis of cost, you're transferring the goods from one department to another department. Very easy. These are very easy things, right? Point is that negotiation base. Matlab, both manager of both department, they are negotiating with each other, and on the basis of negotiation, they are deciding the transfer price of the goods. They're deciding the price at which they are transferring the goods from one department to another department. So the third one is what? Negotiation based method. Let's first understand how they negotiate with each other for the transfer price. What will be this negotiation method? How they will negotiate with each other to decide the transfer price. Let's try to understand this. So if you will see here, we have taken a beautiful image here to decide the transfer price of the goods when we transferring the goods from one process to another process. Right now, I'm making some scenario for you. Okay, I'm just trying to create a scenario for you. I'm just removing these things, all these things. Okay, so what is happening here? This manager is producing the goods here. Okay, processing the goods here. And this manager have option, he can transfer the goods in the market. He has the option, he can sell the goods in the market. Or he has the option, he can transfer the goods internally. Right. So, for example, I will create certain example for you. Try to understand those examples. Okay. Now, the point is that, for example, the capacity of this department to produce 1 lakh units, the variable cost of the units which they are producing is 15. The fixed cost they are incurring is 5. This is the total cost, right? 20 is the total cost. Their expected profit is 4. And they can sell this product in the market at rupees 24. So 24 is the market price at which they can sell this product in the market. Now, what is capacity here? Ma'am, you wrote a word here, capacity. What is the meaning of capacity? So capacity means what, ma'am? Capacity means the maximum unit that you can produce here. Right? Capacity means the maximum production or the maximum unit that you can produce here is the capacity. All right. So you can see here, this department can maximum produce how many units? 1 lakh units. Right. But what is the demand of the product in the market? For example, the demand is only 40,000 units. Right. This is the maximum demand of the units that this department is producing. Abhi dekho, they have the option, they can further process this product to send it to department 2. And then sell it in the market. After that, you have the option to sell it in the market. Right? Or you can transfer it here also for further process. After further processing, sale is possible. But before further processing also, the sale of the good is possible here. So you can sell this good in the market for rupees 24. But the maximum unit that you can sell here is 40,000. And your capacity, you can maximum produce 1 lakh unit. Now, in this example, you can see what I have given, that this department 1 have spare capacity. You can see, khali baitha hai. Spare ka matlab, khali baitha. They have nothing to do. You can see this department have spare capacity. How much spare capacity? For 60 units. Vela baitha hai, right? He has nothing to do. He is actually, for 60,000 units, he is actually wasting the resources of the company if he is not producing the goods, right? So here what is happening for 60,000, we can say this person is having spare capacity. And now the point is that for now the manager of this department is coming to manager of this department and is asking, can you transfer me 35,000 unit? I have a demand of 30,000 unit. Can you transfer me this? He will say, of course, why not? He already sitting idle. He already have the spare capacity for 60,000 units. So obviously he will produce the goods. He will say, definitely, why not? I'll produce the goods for you, right? I have spare capacity. So yes, since he has the spare capacity, he will produce and transfer the goods for department 2. How many units? 35,000 units. He will transfer it. But now the question comes here, at what price he will transfer the goods from department 1 to department 2? What will be the price at which he will transfer the goods? So the price at which he will transfer the goods will be what? What will be the price? At what price he will transfer the goods? So the price, can you tell me? See, the person is already sitting idle, spare capacity. Though he is incurring 15 rupees as a variable cost, he is incurring 5 rupees as a total fixed cost. He is already earning a profit of 4 rupees and he can sell the same product in the market for 24 rupees. But maximum he can sell 40 units. 40,000 unit, he has a capacity to produce 1 lakh unit. For remaining 60,000 unit, he is sitting idle. So what will be the price here? Do you want to answer? What will be the price here? At what price he will transfer the goods? Yes. Do you want to answer? What will be the minimum price he want to recover? What will be the minimum price of department 1 manager wants to recover? Exactly, Janvi. Variable cost, exactly. At least, see, if I will produce extra unit, at least I will incur the variable cost. है ना? So the minimum expectation of this manager will be variable cost, right? The minimum, this manager, minimum expectation, he at least give me variable cost because I'm having spare capacity. So my minimum expectation will be at least recover the variable cost. Below variable cost, he will never go because this is the minimum cost he is incurring for producing the goods. So he will never go below variable cost. He will at least expect to recover the variable cost. He will not go below variable cost. All right, he will not go below variable cost. Okay, so this is his minimum expectation. He want to recover at least 15 rupees. Okay, now the point is that what is the maximum price this person is willing to pay? What is the maximum price this person is willing to pay? I'm just changing the scenario. I'm just adding some more points in this scenario. So transferring how many units? 35,000 units. Okay, what is the maximum price this manager will purchase? See, the point is that this manager have option to buy the same unit from the market. But what is the price he can buy the same product from the market at rupees 16, for example? So if this department manager refuse to give the product, what will happen? The manager of this department, department 2, if the manager of department 1 will say, nah, I will not transfer you the goods, he will say no to transfer the goods, then the manager of department 2 have the option that he can buy the same product from outside market. All right, he has the option, he can buy the same product from outside market at rupees 16. But now the question comes here, okay, maximum price this manager is willing to pay. How much? Rupees 16. Because if he will ignore, he can buy the same product from the market at rupees 16, maximum. But obviously minimum, he will quote minimum rupees kam se kam de do 15, right? Maximum, he will not pay more than 16. This manager of department 2 will never agree to pay more than 16 for a reason. Because if you will not pay the goods at rupees 16, what will happen? He will buy it from outside market. If the manager of department 1 will say, no, I will not transfer the goods to you, what will happen? The manager of department 2 will buy it from outside market at rupees 16. So the maximum price this manager will pay is rupees 16. Now here come negotiation. So what is the maximum and minimum range here? Department 2 manager will maximum pay rupees 16. He will not pay more than 16. It is in his mind. Okay, I will not pay more than 16 and I will try to convince the manager of department 1 to recover, to get the product at least 16 or below this. They will negotiate. And what will happen? The manager of department 1 will have minimum expectation. I will expect minimum expectation is what? Rupees 15. I will not go below 15. So in this way, what will happen? A price range between them will set. They will sit on a table, right? And they have a price range in their mind, right? They will now sit together and they will now negotiate with each other. He will say, nah, I will charge 17, 16. And this person will say, I will not go below 16. At 16, I can buy it from market. So he will say 14, 15. In this way, both will negotiate. and they will reach to a conclusion deciding with each other. So 15 and 16 is the minimum and maximum limit within which the transfer price will be decided between them. Okay. So both of them, they may sit together and they will negotiate with each other and they will decide to transfer pricing, but the transfer pricing will be in between 15 and 16. This is a concept of what? Transfer pricing. They will decide it by sitting together in this way. All right. Now let's change the scenario. So I'm changing the scenario now. Again, I'm considering what? Department 1. And we have a Department 2. So what is happening? Department 1 is buying the raw material and the output will be the input for here. Department 1 have option. This department can sell the product outside market. Or they have the option, they can transfer it here also. This department have option, they can buy the same product which they are buying it from Department 1, they can buy the same product from the market. Whatever the final good will be manufactured, they will sell it in the market. Now what is happening? Again, we have two managers here. Manager. And we have one of the manager here. Okay. So we have two managers here. Now let's talk about the capacity also. What is the capacity of this department? Again, let's consider 1 lakh is the capacity of this department. The variable cost again consider 15, the fixed cost again consider 5, total cost is 20, and the profit they are desiring is 4. So the sale price or the market price is 24. They can sell the product in the market for 24. Achha. What is happening? They can buy the same product from the market for rupees 16. Same scenario. I'm assuming the same scenario. Okay. Now the question comes here, what is the change, ma'am? Change is that, for example, now this department do not have the spare capacity. Whatever they are producing, they can sell the entire unit in the market. So what will happen? They are in a situation that they can sell entire 1 lakh unit in the market. This is their demand. This is the demand. That means they are recovering the fixed cost and they are recovering the profit both here. They are already recovering everything. Whatever they are producing, they are in a capacity to sell the entire unit in the market. And with that, they are recovering both the variable cost. They are recovering everything. They're recovering the variable cost. They're recovering the fixed cost. They're recovering the profit, everything. This is the scenario. Now what happened? Now the manager of this department is coming to here to the manager of this department. And this manager is requesting them to transfer 40,000 units. My first question, for example, let's first assumption that there is no market, they can't buy it from outside market. First example, out of this, first scenario here is that this manager do not have option to buy it from outside market. So this manager is coming here, okay, he's coming here to the manager of this department and he's requesting, can you transfer me the units? Because if you will not transfer, I don't have option to buy it from outside market. First question. Will the manager of department 1 will agree to transfer the goods? Say yes or no. Will this manager will agree to transfer the goods here or no? Yes or no? Can you write? I think I've Screen freeze, no. Now tell me, will this manager be agreed to transfer the goods? Say yes or no. Yes, tell me. Will he agree to transfer the goods? Say yes or no. And tell me the logic also, reason why he will agree to transfer the goods. This manager, department 2, have no option. He can't buy the product from outside market. You can see there is no market exist. He has no option to buy it from outside market. Okay, you can see here this manager have no option to buy it from outside market. While this manager have capacity to sell the entire unit, whatever they are producing, have capacity to sell the entire unit in the market. And after selling the entire unit in the market, this manager is already earning something, right? He is already earning profit. How much profit he is earning? You can see. He is already recovering the fixed cost and the profit. My question, will he transfer the units from here to here? Say yes or no. Whether the manager of department 1 will agree to transfer the goods to manager of department 2, say yes or no. Say yes or no. Quickly. Will he agree? No idea? At least say yes or no now. Will he say no, I will not transfer the goods to you? Does the manager of department 1 have option? I'm already earning profit. Why should I transfer the goods to you? I will not transfer the goods. What will happen? The interruption, right? Department 2 will sit idle then. Department 2 sit idle, and what will happen? Manager of department 2 will say, if you will not transfer the goods, I will complain to the CEO or the managing director of the company. If you will not transfer the goods to me, he will complain to upper authority. He will complain to managing director or the CEO of the company. He will complain, right? So the point is that he will complain. So for that reason, what happened? For goal congruence, if you keep it in mind, goal congruence. So what will happen if you consider the goal congruence? This manager, he cannot say no. I cannot transfer the goods to you. I will not transfer the goods to you. He can't say no. He has to transfer it. But now he will see what is the transfer price he will keep. So because of goal congruence, he can't say no. Because of goal congruence, he can't say no. He will not say no. Okay, he will not say no. But the point is that he will not say no, but the point is that they will decide the transfer price here. Okay. Now listen to me carefully. Okay. This manager is saying that I am already recovering the variable cost here. Also, I am in such a situation that I can sell the entire unit in the market. Because of that, I am already recovering the fixed cost and profitability. If I will transfer the goods to your department, I will lose all the fixed costs that I'm recovering and the profit which I'm recovering from these goods. So I will lose what? This will be my loss. What? I'm already recovering the fixed cost and I'm already recovering the profit. So if I'll transfer the goods to your units, I will lose these two things, profit and fixed cost, which I'm recovering, I'll lose it. If I'll transfer the goods from my department to your department, and this is known as opportunity cost. This is what opportunity cost. So if I'll transfer the goods to your department, I will lose this opportunity cost. So what will happen? The manager of department 1 will say, I want to recover variable cost and I want to recover the opportunity cost. This is my minimum expectation. This is something minimum I want to recover from you. Then only I will transfer the goods to you. Okay. So the manager of department 1 will say, I am already recovering how many units? I'm already recovering how many costs? I'm already recovering the variable cost, which is 15 rupees. I'm already recovering the fixed cost, which is 5. I'm already recovering the profit also, which is 4. If I stop my production, if I stop my sale in the market, I will lose these money. This is my opportunity cost. And I want to recover it from you if you want my product. So the minimum price he will charge in this case will be 24. He will not go below 24 because he is already recovering these money and he's working in a full capacity. He's able to sell the entire unit in the market. He's already working in a full capacity. He do not have spare capacity. He's not sitting idle. Whatever he's producing, he's in a situation to sell all the units in the market. So what will happen? If in such scenario, the manager of department 2 is coming and he is demanding the product, what will happen? He will say, see, if you want my product, I have to interrupt the production for you. Off market. I want to recover my opportunity cost. So the minimum expectation here will be 24 rupees. And what is the problem? This manager do not have option to buy it from the market. You can see here. The manager of department 2 have no option. He can't buy it from the market. Why? Because there is no market for this product. He don't have option to buy it from the market. So whatever the charge he is charging, he has to agree with that. So minimum price that this department manager will charge will be 24 rupees and the manager of department 2 will be agree to get it, right? He will say, okay, no problem, give it to me. So he will agree to get it from manager of department 1. All right. So in this case, the transfer will happen and he will agree to get it at rupees 24. All right. I hope it is clear. This was my case 2. So here, what will be the minimum price? 24. Maximum, nothing. So here the transfer will take place at 24 rupees. All right. I hope it is clear. Next scenario. See, if you want, you can take a screenshot of these because that will help you to remember later on. So better take a screenshot of this image because if you will take a screenshot, it will help you to remember it later on. Let's consider the third scenario. What is case 3? Third scenario. So in case of third scenario, what is happening? Again, the same scenario. We are considering the same scenario. Okay, I'm drawing it. The same scenario, you can see I have taken the same scenario. Okay, the variable cost for the department 1 is 15, fixed cost is rupees 5, profitability is 4, the total sale price is 24. Okay, and the capacity of department 1 is 1 lakh and market demand is 1 lakh. Same scenario. And department 1 have option to sell the product in department 2, right? There is a market for this product. Again, here what is happening, they are working in full capacity. How they are working? They are working in full capacity. So you can see here, they are working in full capacity. Full capacity means whatever they are producing, they are in a situation to sell the entire unit in the market. Right. So, you know, when manager of department 1 is working in a full capacity, what will be his minimum expectation? He want to recover the variable cost. He want to recover the fixed cost. He want to recover the profit, everything. This opportunity cost he will recover for a reason because he is already earning it. If the manager of department 2 is coming and he is asking for the goods, he will say, see, this is something I'm already earning. Why should I interrupt my profit for you? I will recover it from you. So what will happen in this case, the minimum expectation of this manager is what he want to recover the variable cost. He want to recover the fixed cost and he want to recover the profit also. He want to recover everything, right? So this will be what, rupees 24. He want to recover everything. Minimum price he will charge when he is working in full capacity. Right, he will charge 24 rupees, the price at which he is selling the goods in the market. He want to recover minimum 24 because he is already earning it and he is working in full capacity. He is not sitting idle. When he sit idle, his minimum expectation is variable cost. But when he is working in full capacity, he want to recover everything. He want to recover the fixed cost and he want to recover the profitability. Achha, now tell me in this scenario, if there is no market. Sorry, in last scenario, we have assumed there is no market for this product. Now here, for example, a scenario is what? Market exists for this product and he can buy the same product from the market at rupees 18. He can buy the same product from the market at rupees 18. Question is that what will he do now? He has the option. He can buy the same product from outside market at rupees 18. Question here or not, whether the transfer will take place here or not, and at what price. If yes, at what price the transfer will take place. Tell me quickly, transfer will take place or not, and what will be the price? At what price the transfer will be happening? So what price, at what price the transfer will happen and whether the transfer will happen here or not. This is the question. Okay. Abhi dekho, if you will see manager of department 1, their minimum expectation is what? Of department 1. His minimum expectation is that he want to recover 24. He will never go below 24. He will say, see, I'm already earning 24. If you want my product, I will not go below 24. You have to accept it at 24. I will not go below 24. This is the minimum expectation of manager of department 1. Acha. So the manager of department 2, he will have the maximum. He will say, dekho ji, I cannot pay more than 18. Why? Because I can buy the same product from the market at 18. Why should I pay more than 18? Huh? I have the option. I need a 40,000 unit from you, but I have the option. I can buy the same product from the market at 18. Why should I buy from you if you are giving me expensive? So what will happen in this scenario? In this scenario, no transfer will be taken place. You know why? There will be no transfer. For a reason, because this manager, he will say, I will pay maximum 18. Below 18, I will not go. Above 18, I will not go. I will not pay more than 18. Because I can easily get the same product from the market at 18. Why should I pay you more than 18? So this is what he is saying. He's arguing, why should I pay more than 18? I can buy the same product from the market at 18. Why should I pay more than 18? This is what he's saying. And the manager of department 1 is saying, I'm already earning 24 rupees. Huh? I'm already earning the profit. I'm already recovering the fixed cost. Why should I go below 24? I'm already earning it. So what will happen in this case? The manager of both department will sit together, but what will happen? They will negotiate with each other, but they will not reach to any conclusion. They will not reach because this manager will not pay more than 18. This manager will not accept anything less than 24. So what will happen? Negotiation will not reach to any conclusion. No conclusion. So no transfer will take in place. There will be no transfer in this scenario. They will not transfer the goods in this scenario. You can see this was my third case. I hope it is clear. Okay. I hope it is clear. So in this case, there will be no transfer. All right. Okay. Next case. Next case is what? I'm changing the same scenario here itself, right? I'm writing it as a fourth case. Fourth case. I'm changing it a little bit. So fourth case is what? This person have option to buy the same product from the market at rupees 26. This is my fourth case. Where the manager of this department 2 manager, have option to buy the same product from the market at rupees 26. Now think about it, whether under this circumstances the transfer will take place or not. Yes. Now the transfer will take place because what will happen? The manager of department 2 will agree to pay maximum 24 rupees. Why? Because he can buy the same product from the market at rupees. He will now agree to pay maximum 26 rupees because now he can buy the same product from outside market at rupees 26. So he will pay maximum 26 rupees for the transfer. The manager of department 1 will minimum expect 24 rupees. So what will happen now? These manager will sit together, talk to each other, and they will negotiate with each other. And the transfer price range will be between 24 to 26. They will negotiate with each other and they will get the transfer price. So it will be in between 24 to 26. Right? Okay, so you can see in this way we can decide the transfer price. I hope it is also easy to understand. Take a screenshot of it. It will help you later on to understand the same topic if you will forget in future, right? Take a screenshot of this. All right, take a screenshot of all these topics. Okay, we have learned 4 case scenarios here. Okay, I've taken 4 case scenarios here, and now let's practice some questions. Okay, so we have some questions here. Okay, you can see we have some scenarios here, case scenarios here. We have some case scenarios and the question here. So let's do one thing. Let's try some questions. Okay. Okay, so let's take the scenario. What is the first case here? Division A produces goods at a cost of rupees 10. So what is happening here? Division, there is a division A. Always make a diagram in this way. The way I am making the diagram now, always make a diagram in this way. It will help you to understand the scenario, the questions. Okay, division A are producing at a cost. What is the cost they are incurring? Rupees 10 per unit, right? This is the cost they are incurring. And transfer the goods to division B. From division A, they're transferring the goods. Division B, right, which has additional cost of rupees 5. Division B sell externally at, now division B is selling it externally at rupees 16. Their cost is what? Rupees 5. Value addition, the cost they are incurring for the value addition is rupees 5. Okay, the company has a policy of setting the transfer price at cost plus 20%. Okay, so what is the cost they are incurring? Rupees 10 plus 20% will be 2 rupees. So it will be rupees 12 will be the transfer price. Okay. Achha, now what is the question? Profit of each division and overall profit of the company. Now in this scenario, what do we have to find? We have to find out the profitability of each department. Okay, so let's find first the profitability of division A. You know at what price they are transferring the goods? Rupees 12. What is their cost? The cost is rupees 10. So what is their profit? The profit will be rupees 2. This will be their profit. Achha. Now division B is selling the goods at rupees 16. What is their cost? Their cost is rupees 5. And what they are paying to division A will also be their cost. They are paying rupees 12 rupees, I think. They're paying 12 rupees. For the goods they have received from department A, they're paying 12 rupees. This is their material cost. So this is their cost. It is coming as what? Loss, right? How much loss they are incurring? 1 rupee. You can find the loss. ₹1 loss. So there is a loss of ₹1, right? Rupees 1. So now let's take the profitability of entire organization. So entire organization is selling the goods at rupees 16. They're incurring the cost of rupees, how much in division A? The cost in division A is 10 rupees. And the cost of division B is rupees. Cost of division B is rupees 5. So this is the total cost they're incurring. So the overall total profit of the company is what? ₹1. So 2 is the profitability if the transfer price, we follow this method as a transfer price. We are not negotiating. There is no negotiation between the department. For the transfer price, they are following a set standard rule, which is what? The cost plus profitability or the cost plus markup. So the transfer price they are setting is what? 12 rupees. This is what they are setting, right? So what is happening here? You will see what is the cost they are in, what is the profit. If we follow this transfer price rule, the profit of division A will be 2. The loss of division A will be rupees 1. And the overall profitability of the entire organization on one product will be rupees 1. If we follow this rule, right? This will be what? The scenario here. Okay? This is the scenario here. All right. Okay. We follow this scenario. This is right. So we have calculated profit of each division and overall profit of the company. You can see the answer also, right? If you want, I can show you the answer also. So 2 rupees is the profit of A division, minus 1 is the loss of B division, and overall profitability is 1. Okay. So if you're transferring the goods, whatever the price at which you are transferring the goods, maybe one of the division will have the loss due to that transfer good, but overall entire organization will have no loss. You can see overall organization will have no loss, right? When we prepare a cost sheet, overall organization will have no loss. Any specific manager's department will have the losses, on the basis of which maybe he will not get the bonus or appraisal. See, I told you earlier also that we find the profitability of each respective department so that we can find the so that accordingly we can decide the appraisal and bonus of respective managers. That's it. The role of finding the profitability here of these two departments is to find the profitability for finding the appraisal and bonus. That's it. To encourage them, है ना? To encourage them to earn more appraisal, to earn more bonus. So for that reason, they will work effectively for their respective division so that their respective division can earn more profitability. It will be more profitable for their organization. So for to encourage them through appraisal, we ask them to set the price in such, we ask them to set the transfer price in such a way and to do the production in such a way to increase their respective profitability. But if you will see the overall profitability, it has no impact. Transfer price has no impact on overall profitability. Keep it in mind. Okay, whatever the transfer pricing you are deciding have no impact on the overall profitability of the organization. This is what they have written. So it overall, whatever the transfer price you set, whatever the transfer price you will set for the organization, it will have no impact on the overall profitability of the organization. Okay, it will have no effect on the overall profitability of the organization. It may affect the profitability of the respective department or division, but not the entire organization. Okay. What will happen here? Because manager of division B is having losses, so he may get demotivated since the performance of the unit is affected higher internal markup, right? Moreover, since the manager of division A will always make a profit under this method. If you follow cost plus markup method, whatever the method mentioned here, whether the manager of division A work in full capacity or spare capacity, irrespective of full capacity or spare capacity, if this will be the method of transfer pricing, cost plus markup, this manager will always earn some profit of 20%. He will always earn profit and he will always get the bonus and appraisal. But in this method, the manager of division B may have the losses and his appraisal and bonus may get affected. So this is what written here. If the company will keep following this method, cost plus markup method, so this manager will be demotivated, because this manager, whether he is working good or not, whether he is working in spare capacity, खाली बैठा हुआ है फिर भी उसको bonus मिल रहा है, खाली बैठा है फिर भी appraisal मिल रहा है, not good ना? So खाली बैठा है but still he is receiving the appraisal and bonus. Not good, right? So for that reason, we will see whether he is working in full capacity or whether he is working in spare capacity. He will keep getting the bonus here because of the profitability, because of this method cost plus markup, which is not good for the organization. All right. Okay. Let's do the next question. Read this question, then we will discuss. Read it, and then we will discuss. Okay. Shall we discuss? Shall we discuss this question? So, see what will happen here. Let's read the question first. So, what is happening? G is transferring division and R is receiving division. Okay. So, what is happening? G is what? R is what? We have two division, G and R. We have two division. G is transferring the goods to R. G is what? Transferring division. R is what? Receiving division. Okay. G is transferring the good, R is receiving the goods. Okay. R has a demand of 20% of G's production capacity. Okay. So for example, if G has a production capacity of 1 lakh. Okay. So what is the demand of R? 20,000 units. 20%. Okay. So R has a demand of 20% of G's production capacity, which has the first met as per the company's policy. State with reason which division, G or R, enjoy more advantage in each of the following independent situation. These situations are independent and you have to tell them who will enjoy more if these scenario will be set up. Okay. Okay, so what is the scenario here? First is that transfer pricing is what? Full cost. That means variable cost plus fixed cost. Okay. If this is the transfer pricing. Now, question is what? G production capacity is 60%, external demand is 40%. So production, how much they are producing? Production, they're producing 60,000 units. Okay, out of 60,000 units, they are transferring the goods outside market. How many units? 40,000. Okay. So they have a production of 60,000. Out of 60,000 external demand, they are transferring 40,000 outside market. Now they have a demand from receiving division of 20,000. They are transferring the goods at variable cost and fixed cost. Question. If this is the transfer price, who will be in a position of gain? Who is having more profit? The manager of department G or the manager of department R? Manager of department G or the manager of department R? Who is having the maximum profit here? Tell me. Kaun karega jhinga lala? Tell me, who will be very happy with this? Yes. Department G. Oh, very nice. Yes. Exactly, Department G. Why? Because, see, minimum expectation here. Because you can see here, he has ideal capacity. Manager G have here, he is producing more, but he is able to sell only 40,000 units. Out of 60,000, he can sell only 40,000 unit. तो 20,000 यूनिट क्या हो गई? फालतू बना दी उसने. फालतू है. अब ये फालतू यूनिट वेरिएबल कॉस्ट में बिक जाती, मजा आ जाता है उसको बस इतने में. बट इंस्टेड ऑफ जस्ट रिकवरिंग द वेरिएबल कॉस्ट, ही इज रिकवरिंग द फिक्स कॉस्ट ऑल्सो. ही इज रिकवरिंग बोथ. राइट. सो कौन मजे कर रहा है ज्यादा? हु इज इंजॉइंग मोर? मैनेजर ऑफ जी. है ना? ओके. I hope it is clear. Manager of G will enjoy more. Chalo. Let's see the second scenario now. Okay. What is the second scenario? Let me change it. So here, you can see the manager of G will enjoy more. Very nice. Acha, chalo, change the scenario. I'm changing the scenario, second scenario. What is the scenario? Market price is the transfer price. अरे वाह, मजे आ गए. The transfer price is what? Market price. अब देखो market price का मतलब what? The person, manager of G, this department manager, this one, is recovering the variable cost. He is recovering the opportunity cost, which is fixed cost as well as profit. He is recovering here everything. Yeah. Now the point is that production level, this manager can produce maximum how many units? 80,000. This manager can maximum produce 80,000 units. Out of the 80,000 unit, the demand outside is what? Only 60,000. Demand is what? 60,000. Question. If the transfer price is setting as variable cost plus fixed cost plus profit, everything is recovered here. Okay, so this is the transfer price for these 20,000 units. Who will enjoy more? Who will be happy more? Who will be doing bhangra? Who will be happy here more because of this transfer pricing? Kaun karega jhinga lala? Tell me, who will be more happy? Yes, in this scenario, who will be more happy? Tell me. Yes. Acha. Okay. So she has answered. Okay. So yes, department, again, this is more profitable because he has again a spare capacity. Hai na? You can see he has again a spare capacity. So again, his minimum expectation, the minimum expectation of manager G was variable cost, but he is recovering everything. Variable cost plus fixed cost plus profit. Obviously, he will be very happy. So here G will be happy. Here also G will be happy, right? Okay, next scenario. So in next scenario, what is happening? So where it is marginal cost. Abhi see here what is happening. His production level is what? 1 lakh unit. He is actually producing 8 lakh unit. And he is externally selling how many units? 80,000 units. Okay. 80,000 units. And the demand is what? 20,000 units. But now the transfer price is variable cost. So if the transfer price is variable cost, he is having no gain. Now, the manager, this was the minimum expectation. No, he is just recovering his minimum expectation. No profit here, right? So in this scenario, manager G will have no profit. In this scenario, R will enjoy. You know, because he got something at very less price. Cheap, he got something at very less price. So now R will enjoy. Okay, the last scenario is what? 1 lakh production and he's selling outside 90,000 units. He's selling outside 90,000 units, but there is a demand of 20,000 units. He has to interrupt his production for R. Now, what is happening? Transfer price is setting at market price. So this is his minimum expectation. He will not happy, right? Because he's already earning the profit, right? He was already selling the product at market price. There is no profitability for him. Okay. So who will enjoy here? In the last scenario, R. In the last scenario, who will enjoy? Okay. In the last scenario, what will happen? Achha, one more point I forgot to tell you. Just give me 1 minute. So what is happening in this scenario? You can see there are two kind of things happening here. You can see he is already selling 90,000 units in the market. He can produce maximum 1 lakh unit, and there is a demand of 20,000 units. So you can see here he has a spare capacity. How much? 10,000 units. This is what spare capacity. For the spare capacity, his minimum expectation was variable cost. But instead of variable cost, he is recovering the market price. In last case, what is the price? It is the market price. ठीक है. So for the minimum, for the 10,000 unit, because he's already producing and selling 90,000 unit in the market, he's producing 1 lakh unit, but out of it he's selling 90,000 unit in the market. So for 10,000 unit he has the spare capacity, है ना, ये फालतू पड़े हुए हैं. Isco, he just want to recover the variable cost. But what is happening? He is recovering market price. So happy, he is very happy for it, right? He is recovering more than what his minimum expectation. He was just expected to receive the marginal cost, but now he is recovering market price. He is happy for this. ठीक है. अच्छा, for the remaining 10,000 unit, because we have to transfer 20,000 units, right? For the remaining 10,000 unit, for the remaining 10,000 unit, what will happen? You can see for the remaining 10,000 unit, he has to interrupt his outside sale. So instead of 90,000, he can sell only 80,000 units. Remaining 10,000 unit, he has to transfer it here, right? And 10,000 unit is a spare here. He will add those 10,000 units. So total will become 20,000 unit now. So remaining 10,000 unit, he was already earning the fixed cost and profit. He was already recovering everything, right? He was already recovering the profit and fixed cost. So for this, his minimum expectation was market price, and he's transferring the goods at the market price. For this, he is not happy, because he is recovering the minimum expectation, not more than that. So not for these 10,000 units, but for this 10,000 unit, he will be happy. I hope it is clear. If you have doubt, I can repeat again. If you have doubt anywhere, please ask me in comment. I will repeat again. Say yes or no. Do you have any doubt here? If you have a doubt, I'll repeat, no problem. So Janvi, your answer was wrong for what? Third and fourth is wrong here. Huh? Please check it. Third and fourth is wrong. So third, R will be happy. Fourth, G will be happy. Is that okay? Now what will happen? Let's take a break now. And then we will take more questions. Huh? So it's all about practice. We will practice a lot here. Okay? But before that, let's take a break. Okay, hi, back. Let's come back to the session. So let's take some more question. Let's take some more question. Okay, let's take these two questions. So I expect all of you to read the question first, then we will discuss it. All right, so this is a question, and I expect all of you to read it first, and then we will discuss the question. Yes, read it first. Read the question. All right, read the question first, then we will discuss it. Take your time, take 2-3 minutes, take time and read it, and then we will discuss this question. Yes, please read it. Read the question. Then we will discuss it. Yes. So what is the question? I hope you have done the reading. Yes. So what is the question? This question is based on market-based transfer pricing. Okay. So you have learned that either we set the transfer price, it may be cost-based transfer price, it may be market-based transfer price. Either we set the transfer price between the department, or what we do, either we set the transfer price, or the manager of transfer different department, they negotiate with each other. They negotiate with each other to decide the transfer price. So either we set the transfer price, or the manager, they negotiate with each other to decide the transfer price. This is how the things happen here. All right. Okay. Now let's read the scenario here. So what is happening here? A manufacturer of cornflakes has two divisions. One producing cornflakes and another packaging division that manufactures the cartons. Oh, so in one of the division, what is happening? They are producing what? Okay, let's assume this one. They're producing cornflakes. And on the other division, what is happening? They are preparing the cartons. They're preparing the cartons for the packaging of cornflakes. The production division manager, the production division purchases all the cartons from the packaging division. So what is happening? This division, production of cornflakes, they buy the cartons from division, division, right? They're buying from here. Yes. Read it carefully. Read the question carefully. Draw the diagram. The way I am drawing here, the diagram now, always try to make a diagram. This will help you to understand the question. All right. Okay. Then the cost of cartons from outside vendor. So instead of producing the carton inside, if you buy it from outside, what is happening? If you're buying 5,000 units, you can buy the cartons for 77,000. And if you're buying 8,000 cartons, you have to buy it at 95,000 rupees. So this is the price at which you can buy it from the market. You have the option. Either you can get it from internally or you can buy it from outside market. All right. Then production costs incurred by packaging division of similar volume of cartons is what? Okay. Production cost is what? Instead, if you can buy it from the market, this is the price at which you can buy it from the market, and this is the price at which you can produce within the organization, right? This is what production costs. You can produce these units inside the organization, and this will be the cost you will incur for the production. These are production costs. All right. So for 5,000, the production cost is 75,000 for the cartons, right? This is the cost for cartons. And for producing 8,000 units, the production cost is 80,000. All right. Okay. What next? The production and sale of the final product, cornflake. Ab dekho, final product is what? Cornflakes in a packet. In a packet, you have what? Cornflakes. So the final sale value, if you are selling number of cartons of cornflakes sold, if you sold 5,000 packets or if you sold 8,000 packets. So what is happening? The total sale value of the cartons with the cornflake is 2 lakh, and the total cost, including the cost of the cornflake as well as the cartons, the total cost is 1,20,000. Similarly, for 8,000 unit, what is happening? The sale value is 3 lakh. And the cost which we are incurring here is what? The cost of the cornflake and the cost of the carton is 1,80,000. These are the costs we are incurring here. What is the question? An appropriate transfer pricing policy is being framed as the corporation management account calculate what? Transfer pricing based on if the transfer price is first shared profit relative to cost method. Whatever is the total profit will be shared between them. On what basis? The cost incurred by them. Okay, this is one of the method. Second method, based on market method, they are transferring the goods. Okay. So what do you have to do here? You have to find out the transfer pricing considering these two methods. Then what do you have to do? You have to calculate the profitability of each of the division, right? You have to find the profitability of each of the division under these two different methods. And then discuss the effect of both the methods on the profitability of the division, right? You have to consider the effect of this on the profitability of each of the division. All right. Okay. Now let's do the question. So what is happening here? They have already decided the basis of transfer pricing. So they have decided first method is what is happening. The transfer pricing, firstly, second method is on the basis of market. On the basis of market, you're deciding the transfer pricing. This is one of the method. And the second method is what? A shared profit. Whatever the total profit the company is having, the total profit will be distributed between these two departments on the basis of what? The cost. On the basis of the cost, we will allocate the profit to these departments. All right. Now, what do we have to do here? We have to find the profitability in both the cases. Okay. What I'm doing here, I have 3 things to consider. Not just 3, I have 6 things to consider. Let me do one thing. I am preparing a table. So what do we have here? We have division, and the total organization's profitability. Okay, so what do we have here? Division 1, the carton division and the cornflake division. Cartons division and the cornflakes. And the total profitability. Because the total profit will be distributed amongst them on the basis of their total cost. Okay. Okay, total company profitability. Right. Okay, this is the scenario we have. Now let's see, because we have to calculate it for 5,000 unit as well as for how many units? We have 2 different units. We will calculate it for 5,000 units and then we will calculate it for 8,000 units. All right, I'm just writing it here so that we can keep it in mind that we are first finding it for 5,000 units, then we will find it for 8,000 units. Right? These are the number of units we have here. Okay. Now what we have to do, we have to consider the final sale value of these final units, the sale value. I'm just considering the sale value. The final sale value when we are selling how many units? 5,000 units. The final sale value is this. Yeah? 2 lakh is the final sale value. All right. And then we will consider after this, what is the total cost? What is the profit? The company's product information that the total final sale value will be 2 lakh, the total cost will be 1,20,000. So this will give the profitability for this 5,000 units. All right. Okay. Now what is mentioned here? This profit will be in first case shared profit. Profit will be shared to cost method. You will first see what are the costs for these 2 products, and then on the basis of the cost, we will allocate the profit to them. All right. Okay. Now let's see what is the cost for these 2 products. I can see. Acha, no. See what is given here. This is the total cost excluding the cost of the cartons. Okay. So this is the cost excluding the cost of the carton. So what is the cost of the carton here? 75,000. All right. Okay, so this will be only 5,000. Give me 1 minute, huh? What is the cost of production here? All right. Now, what do we have to do? We have to allocate the profit amongst them. है ना? So whatever the profit we have here, 5,000 is the profit. We will allocate this profit to them. है ना? Okay. You can see here we have a profit of 5,000. We will allocate this profit to them on the basis of what? Their cost ratio. What is the cost ratio? 75 is to 120. On this ratio, you will allocate the cost to these two products. So what is it? You can see 195 is the total, right? So 5,000 into 75 divided by 195 as well as 5,000 into 120 divided by 195. So in this way, we will allocate the cost to them. Okay. In this way, we will allocate the cost to them. Okay. We will allocate the cost to them. What is it coming? I need a calculator. So this is coming as 1923. I can write it here, rupees 1923. Okay. And for the next one, $3076. So this is how we will allocate the profit to them. What will happen? So on the basis of these two, we will decide actually the transfer price. So what will happen here? The cost is incurring, we are incurring, this is the cost, this is the profit which we have allocated here. Based on this, you can find the price at which cartons will be transferred to cornflakes. Right? This will decide the price at which the cartons will be transferred to cornflakes, right? So this will be what I can see the transfer price will be rupees 76,924. All right, this will be the transfer price. Then what will happen here? You can find the sale price of the goods. How will you decide the sale price of the good? 123,076 will be the sale price. Okay. This will be the sale price. Okay. This is the sale price of the goods we have here. All right. Okay. This will give the profitability for these two division and the total division. This is how you are deciding the transfer price as. So here the transfer price for the cartons is this. And the final sale value of the cornflake will be this, right? If you add them, you will get the total sale value. No, just give me 1 minute. Okay, so what will happen? What else will happen here? Give me 1 minute. What will happen? The price at which you are transferring the cartons to this division, the price at which you are transferring the cartons to this division will become the cost for this division, right? So this will actually become the cost. Cartons will become the cost for this division. Right? And with this, we will decide the sale value here. This will be the final sale value of the product, right? Because whatever is the see, this is what the transfer price of the cartons, right? It will become the cost here for this division. It will be a cost, right? So this will be the total cost. This is the profit you want to earn. So accordingly, the final sale value of this product will be decided. All right. Okay. So if I'll add these value, I'll get the total sale value. Right. This will give me the total sale value, which is 2 lakh, right? You can see here it is coming as 2 lakh. All right. So this is coming as 2 lakh, right? So this is how we are deciding the transfer price by what the method is what? Shared profit to cost method. Matlab you are sharing the profit on the basis of the cost. You are allocating the profit on the basis of the cost to these two different, right? You're allocating the profit on the basis of the cost. You can see here we have considered the cost. On the basis of the cost, we have allocated the profits, right? Asha, you can do the same thing when we are selling how many units? 8,000 units, right? We can do the same thing when we sell 8,000 units. Okay, and now I'm doing the same thing when we are selling 8,000 units. So we are calculating the same when we are selling 8,000 units in the market, right? Okay. So how many cartons we have here? Same calculation. I'm doing nothing new, right? Just same calculations. When we are selling how many units? 8,000 units. Total company profitability. And the sale value is total cost. Will give me the profit, right? Okay. So what is the sale value? You can see what is the sale value? 3 lakh. For 8,000 unit, the sale value is 3 lakh. What is the total cost? For the conflict, 1,80,000 is the total cost. You can see what is the total cost. So you can see when we are selling 8,000 unit, the total cost is 95,000. When we are selling how many units? Not this one. This is the total cost, right? 80,000. When we are selling 8,000 units, the total cost is 80,000. And for the conflict, 1,80,000, right? So the total cost coming here is rupees 8,000. plus rupees 1,80,000 is the total cost, right? $80,000 and 1,80,000. These are the total costs we are incurring, है ना? All right. Okay. Writing it the way we have written above. So these are the two costs. One is for the cornflake and another one is for the cartons, right? I can write it here. This is for cornflakes, right? And this is the cost for the cartons. All right. This is a cost for the cartons. Okay. Then what is happening here? The total cost and the final sale value is what? 3 lakh. Achha. Actually, this is the total cost we are incurring. But here, this is the total cost we are incurring for both. You know? So after considering it, we will get the total profit. All right. What I can see here, 2,60,000. So 40,000 is the profit, right? Now this 40,000 cost will be allocated to these products on the basis of the cost you are incurring here. Here the cost is what? 80,000. For the cartons, the cost is 80,000. For the cornflake, the cost is 1,80,000. Now I'll be using this ratio to allocate the profit to them. है ना? So what is happening? The total value I can see is 2,60,000. है ना? 80 plus 180 is 260. So I have a profit of 40,000. Okay, I have a profit of 40,000. I'll allocate it 80 divided by total 80 plus 180 is 260. है ना? 80 plus 180. So this is 260. What is it? 80 plus 180 is 260. All right. Next 40,000 into 180 divided by 260. So these are my These are my ratio on the basis of which I will allocate the total profits. है ना? Okay, so what is the answer here if I'll consider these values? 40,000 into 80 divided by 260. 12307 rupees 12307. Achha, what will be the value here? Rupees 4180 divided by 260. 40,000 180 260. So this is coming as 27692. This is 27692, right? That's it. Achha. Now what will be the transfer price here? Transfer price will be what? The cost plus profit is the transfer price here. I can see here 92. I can see 92,307 is the transfer price. है ना? This is the transfer price we have here. 92,307, right? This transfer price will become a part of the cost as we have discussed because the unit will be transferred from here to here, right? It will be transferred here. So the transfer price cost will be coming here as rupees 92,307, right? This will be the transfer price that will be coming here. This transfer price will be coming here. Okay. So now what is the sale value? You can just add all these values. You will see it is coming as 3 lakh. If you add all these value, if you want, I can just check and confirm. This is coming as 3 lakh, right? One value is less. I can add it anywhere. Like if I add it here, 3, you will get the answer. Okay. So in this way, you can see that here what is happening, they are just allocating the total profit to these two products, to these two department on the basis of the total cost. On the basis of their cost, they are allocating the profit to these two divisions. Then what is happening, and on the basis of the profit allocated to them, they're finding the total cost and they're finding the transfer price for them. Simple, right? So you can see in this way, they have done what? They have calculated the transfer price for the product on the basis of shared profit based method, right? Shared profit relative to cost method. They have used what? Shared profit relative to cost method. They have used this method to find the transfer price. You can see we have first calculated the total profit of the company, considering both the total sale value, final sale value, and the total cost, considering it. We have calculated the total profitability of the company. Then we have allocated the total profitability of the company to these two divisions on the basis of the total cost. We have seen what is the total cost. This is the total cost of this department, and this was the cost for this department. On the basis of the cost, we have allocated the profit to them. Then considering the cost plus profit is selling price, right? So you calculated the transfer price. This transfer price, this product will transfer here. So transfer price will become the cost here. The transfer price is revenue here, but cost is there, right? It is revenue here. It is revenue here, but it's a cost here, right? So accordingly, you have everything, right? So we have done it for 5,000 units and we have done it for 8,000 units. All right. I hope it is clear. I hope it is clear. Now let's do the second part. Second part is what? Find the transfer price on the basis of what? Market method. All right. On the basis of market method, we are finding. So we are doing the next portion of it. You can see it is so simple. If you will see the explanation looks quite difficult, right? You can see here, it looks like quite difficult here, difficult to understand, but you can see actually it's very simple, right? It's very simple. You can see how easy we can find it. Acha, one more thing, they have calculated the transfer price per unit also. So give me 1 minute, let me help you to see, because you can see in the explanation they have calculated the transfer price per unit. So let's find it per unit also. Let's do the calculation per unit also. So what is the transfer price here per unit? Transfer price will be 76924 divided by the number of unit is 5,000, right? So this is coming as what? 15.3848. Okay, let's see the transfer price here per unit. Transfer price per unit is what? 92307. Divided by how many units? 8,000 units. This is the transfer price. You can see, you can get the transfer price easily here. So this is the transfer price. You can see, we can very easily calculate the transfer price here. Okay. Now the next scenario. Next is what? Based on what market method we are finding the transfer price. You can see with the transfer price, you can find the respective profitability of each of the division. You can find the profitability of entire organization, and keep it in mind. I'll show you later on that no matter what transfer price you set, whether it is cost method, it is marginal cost method, negotiation method, profit method, whatever the transfer price you set for the division, keep it in mind the total profitability will not get impacted. The profitability of each division will get impacted, but the entire organization profitability will never get impacted because of transfer price. So transfer price will never impact the overall profitability of the organization. It will only impact the profitability of the respective department, right? So this was my method to find out the transfer price on the basis of profitability. Transfer price, this was my method. Transfer price on the basis of profitability. So on the basis of profitability, here we are finding the transfer price. है ना? अच्छा, let's see the next scenario where we will find the transfer price on the basis of market price. Okay, so transfer price on the basis of what? What is the basis of transfer price? Market method. Huh? Market method. So now we are finding it using market method. All right. So let's do the calculation. The same thing, I'm taking two tables here. All right. So one for 5,000 unit and another calculation I'll do for 8,000 units, right? This is my cartons division. And this is my cornflake division. Right, this is my total. Of the organization. ठीक है? And here we are considering how many units? 5,000 units. And here also we are considering 5,000 units. And these are the total units, 5,000 units or 5,000 units, total profitability we are finding. Okay, here we will do the calculation for 8,000 units. All right. We're doing the calculation for 8,000 units. And here what is happening? Complex division. How many units? 8,000 units. Okay, total. Okay. So we are doing this calculation and the method is what? Keep it in mind. See, they're also asking you find the profitability of each division, discuss, right? So we have calculated the profitability, right? If you will see in the last calculation, we have calculated the overall profitability of each of the division. We have calculated it. Here also we will do the same thing and then we will do the discussion also. All right. Okay, now let's do it. On the basis of market price, we are deciding the transfer price of the goods. Okay. Okay, the sale value and the cost less cost, right? This will give the profit. All right, so this will be my sale less cost and the profit we have. Okay. So we are considering all these things here. And what happened? profit, sale, less cost, and profit, right? Okay, so here what is happening? Sale means here we will decide the transfer price here for this product. And we will decide the transfer price when we are transferring how many units? 8,000 units. Okay. Now the point is that it is mentioned that we will consider the transfer price considering the market method. So this is given here that we will decide the transfer price on the basis of market method. Now you can see in the market for 5,000 unit, the transfer price will be 77,000. And in the market for transferring how many units? 8,000 unit, the transfer price is 95,000. This is what? On the basis of market, we are deciding the transfer price. We will see at what price the product is available in market. On the basis of that, we are deciding the transfer pricing. All right. Okay. So I am taking 77,000 for 5,000 units and 95,000 for 8,000 units, right? Okay. 77,000 here is my transfer pricing. And here my transfer pricing will be 95,000, right? This is my transfer pricing. I mean, I will say such a simple question. I mean, you don't even have to apply your brain and you can get so easy. I mean, if such question will come in exam now, you will get marks like this, right? You can see it is so simple. Not at all difficult, right? You just have to do some plus minus calculation. Dimag bhi nahi lagana hai, right? Everything is given. Matlab transfer price bhi nahi decide karna. You don't even have to decide what should be the transfer price. It is already given ki transfer price ye hoga. Then karna kya hai? Nothing. You just have to find the profit. Kuch bhi nahi karna. It is such a simple question, right? Okay. Now the point is that the cost is given for this division. What cost is given? 1,20,000. This is 1,80,000 when 8,000 units we are selling. And here the cost is 1,20,000. It is given now. You can see the cost of the division where you are producing what? Sorry, I'm so sorry. So the cost of the division where we are producing the cornflakes are these costs, right? When we are producing 5,000 units, the cost is 1,20,000, and when we are producing 8,000 units, the cost is 1,80,000. This is given, right? Okay. What else is given? The final sale value is given for these products, which is 2 lakh and 3 lakh. Okay. So this means the price at which you will finally sell your goods is given. Okay. And the cost of these division is given. What is it? The cost of these division is given. What cost they are incurring? 75,000 for carton division cost is given, right? Give me 1 minute. Okay. So if you will see, production cost is this, right? This is what? Production cost. So the production cost of these two divisions is given. The cost which we are incurring here is 75,000 and 80,000, right? So you can write these costs here. 75,000 and 80,000 is the cost they are incurring here. Rupees 75,000 costs you're incurring here and rupees 80,000 costs you're incurring here. All right. Okay. Now the transfer price is already decided, right? And the cost is already given. So you can find the profitability in both the cases, 5,000 and 8,000 for carton division. And keep it in mind, the unit that you will transfer from here to another division, right? From here to another division, right? So the cost, this is what the revenue for them, right? This is revenue for them, right? Revenue for them. Revenue for one division will become cost for another division, right? Because they are buying the product, they are selling the product. This division is selling the product, right? They are selling the product. And this division is buying the product. What product? The cartons, dabba. Okay. So the cartons division is selling the cartons. So it is revenue for them. Conflict division is buying the cartons, so it is cost for them. So transfer pricing, which we are deciding on the basis of market, will be cost here. So this is what 77,000 is the cost here. All right. Okay. And similarly here, the cost will be 95,000. These are the costs for them. Okay. Right. These are the costs for them. You can see. Okay. This is the total cost for them. Now, what do we have to do? We have to find out the profit. All right. Okay. Let's find the profit now. Okay, I hope it is clear. So when we transfer the goods from one division to another division, okay, this is transferring. So it will be a revenue for them. And we transfer it from here to here, it will be cost for them. Right. So this is what we have done. For one division, it is revenue, and for other division, it is a cost. All right. Okay. What else do we have to do? We have to find out the profit now. Okay. Calculator. I need a calculator. So let's do the calculation. 77,000 minus 75,000 is what? I know. 2,000. 2,000 is the profit, right? Okay. Here, what will happen? You are selling the final goods at rupees 2 lakh. And this is the final sale value. Where is it given, ma'am? You can see that final sale value is given is, you can see, this is the final sale value. It is given. Huh? Final sale value is already given. 2 lakh and 3 lakh is the final sale value. It is given. Huh? So I'm considering those final sale value for these units. For 5,000 unit, the final sale value is 2 lakh. And for 8,000 unit, the final sale value is 3 lakh. Now, let's calculate the profit of each of the division. So you can see for the carton division, when we are selling 5,000 unit, the profit is coming as 2,000. And here the profit is coming as rupees 15%. Okay. Achha, now let's calculate it for conflict division also. Now I need calculator. Achha, here it is coming as, I think, 3,000. Okay. This is coming as 3,000. And this will be what? Rupees 25,000. Okay, I'm just confirming it because I've done it in my mind. So I'm just confirming that this is correct or not. Okay, 2 lakh minus 120 minus 77,000, 3,000. Okay, 300 minus 180. 25,000, correct. All right. And similarly, you can find the total profitability of the entire organization also. Here, final sale value will be 2 lakh. Finally, you will sell the goods at 2 lakh, right? Here, the final sale value will be 3 lakh. What is the total cost for the organization? The total cost for the organization will be 1,20,000 and 75,000 is the total cost for the organization. Because they are buying it at, so what will be the total profitability? Give me 1 minute, huh? Yeah. So what will be the total profitability? 5,000. Similarly, here with what will be the total cost? 1,80,000 and 95,000 is the total cost. No, not 95,000 rupees, 80,000. This will be giving you what? Rupees 40,000. Okay. So you can see here conclusion. Now I'm giving you the conclusion. Conclusion is that irrespective of what you have decided the transfer price, in one In one case, you have taken the transfer price on the basis of profitability, and on other case, you have consider the transfer price on the basis of market price. And you can see we have different cases here, different method here. One is what? Market method, and another one is profitability, right? On profit was distributed on the basis of the cost. These were the two methods we had. Now the point is that irrespective of what method you follow, total profitability of the company will remain same. You can see the total profitability of the company is coming same, right? It is not coming different. Irrespective of what method you are following, the total profitability of the entire organization will remain same. It is coming same. You can see. And though if you follow different method, transfer pricing is on the basis of market method, marginal method, negotiation method, whatever the method. If you use different method for deciding the transfer price, what will happen? The profitability of each of the division may differ. Like here, 2,000, 3,000, you can see here, 1,900 and 3,000 something. So the profitability of each division may vary. Similarly, 15,000, you can see here, 12,000 is coming here, 25,000 is coming here, 27,000 is coming. Point is that when you use different method for transfer pricing, profitability of each division may come different. Like here, the profitability of each division is coming different, but the overall profitability of the entire organization will be same. You can see here the overall profitability of the entire division will not be impacted by the method of transfer pricing. Keep it in mind. Okay, this is what I want to explain you here, that if you want, write this line: overall profitability of the organization will not be impacted by the overall profitability of the organization will not be impacted by the transfer pricing method. So you can see whatever the method you follow, whether it is market price method, whether it is on the basis of marginal costing, whether it is on the basis of total cost, whether it is based on total cost plus markup, whatever the method you follow, कंपनी का ओवरऑल प्रॉफिटेबिलिटी विल नेवर इम्पैक्टेड. तो फिर फायदा क्या है? व्हाट इज द यूज ऑफ यूजिंग द ट्रांसफर प्राइसिंग? वी फाइंड द ट्रांसफर प्राइसिंग, वी यूज द ट्रांसफर प्राइसिंग मेथड टू फाइंड द profitability of each division, right? We want to find out the profitability of each division, right? Why? Because on the basis of the profitability of each of the division, what happened? The manager of these division will get what? Bonus, commission, appraisal, right? And it motivate them to perform better. Okay? For the motivation of the managers of their respective division, we decide or consider the method of transfer pricing, and we find the transfer pricing. So for them, we consider it. I hope it is clear. All right. Okay. Now let's take one more small question because half an hour left. I hope it is clear. You can see it is such a simple question, not at all difficult, right? You can see just profit we have done. We have just calculated the profit. You can see such a simple question. You can see the way they have calculated here is quite difficult to understand. The way they have solved it here is quite lengthy. You can see quite difficult to understand, but actually it is not at all difficult. Achha, let me do one thing. The way it is calculated here looks difficult, but it is not at all difficult. Achha, one more thing I forgot to do. Here, transfer pricing per unit. Let's find the transfer pricing per unit also. 77,000 divided by 5,000 is this. Right, this is the transfer price. And here, market-based method में 95,000 divided by how much? 8,000 units. This is coming as this, right? So you can see how simple it is. All right. Simple, very easy. All right. Now let's do one more question on this topic. We have time. So let's do one more question. The next question. Okay, so let's do the question, this one. I'll give you time, read the question, then we will discuss. Huh? So take your time to understand the question, then we will discuss. Read it. Read the question. Okay. So read it, then we will discuss. How easy. When they have already set the transfer price, I will tell you the question will be very easy. If you will try and solve such question now, where they have already decided the transfer pricing, आपको कुछ नहीं करना then. It is so simple. So the question may be difficult where you have to decide the transfer price, considering the scenario. When you have to find out the transfer price, maybe the question will be difficult. But in the question where they have already set the transfer price, like here, they have already set it, it will be very easy. Keep it in mind. Read it. Then we will discuss. Okay, let's read the question now. So GIOR Armina is an Italian luxury fashion house. Okay. Which designs, manufactures, distributes, and retails youth culture, ready-to-wear leather jackets. Okay. In 2016, estimated sales of the company were around 2.65 billion. Okay. So the estimated sale of the company was around 2.65 billion. Okay. Then the Gior, this company, Armina, announced that his company will revamp two fashion labels, Armina and, okay, Collezioni and Jeans. They are just revamping these two fashion labels as a part of restructuring process of his company. Okay. And then the company has two profit center, A and B. Profit centers A sells half of its output on the open market. Okay, whatever the units they have, half of the unit they sell it external market and transfer half of the unit to B. ठीक है, तो देखो A and B are the two division. Whatever the units they are producing here, they sell half of the units in the market. Half of the units they sell it in the market. And half of the units they are transferring here. Half of the units they are transferring to division B. All right. For an accounting period cost, an external revenue was given here. The external sale, whatever, the external sale, okay, let me write it here. The external sale is rupees 8,000. So half of the unit they are selling outside and they're selling it for 8,000. Achha, the cost of production is what? Of production. The cost they are incurring in division A is what? 12,000. for entire unit. So for example, they are producing 10,000 units. So 5,000 units they are selling outside, right? And 5,000 maybe they will transfer here, right? These are the units they are transferring. Now the point is that this total cost, this is the cost for entire 10,000 units, right? This is the cost for entire 10,000 units. All right. Then what is happening here? Now B is selling the goods. External sale they have, and total cost of production they have. And what is happening? The total is also given. So I can see the total. Okay. So total sale is given. And now the question is that what are the consequences if the company decided to set the transfer price at market price? Okay. So what is happening here? They are setting the transfer price as market price. What are the consequences? My point is that if you will ask me, ma'am, what are the consequences if you can see here they have decided the transfer price as market price? I will say it is not good for division A. Why? No, it is very good for division A, but maybe it is not good for division B. Why? For a reason. Because division A have a spare capacity. Whatever they are producing, 10,000 units, they are not able to sell it completely outside the market. For the remaining 5,000, actually they had the spare capacity. For the spare capacity, minimum expectation is variable cost. That's it. Marginal cost is the minimum expectation, but they are getting market price, which is good for them. So division A should be happy with this. With this, the division A should be happy. That's it. If they are just asking for the consequences, I can write it in the answer and khatam. Profit नहीं find करने के लिए बोला. They have not asked you to find the profit here. They have just asked you what are the consequences. I will say division A will be very happy with the transfer pricing decision. Why? Because they had spare capacity. Their expectation was to recover the variable cost only. But instead of recovering the variable cost, here they are recovering both variable cost as well as profit, opportunity cost. They are not losing anything here, right? No opportunity cost. Opportunity cost is zero here. So they are recovering more than what they have expected. It is profit for them, right? It is good for them, right? So A will be very happy with the transfer pricing decision. That's it, khatam, right? Okay, let me see what they have written in the answer. Okay, they have calculated the profitability. We will find it. I think this question have different part. Okay, give me 1 minute. Okay, let's do one thing. Let's find the profitability first, then we will take the decision. Take care. By the way, the decision will be clear, right? But still, let's find the profitability also of both the division here. Okay, let's find the profitability of both the division here. I'll be making a table that will be easy for us to solve it. So what is happening here? We will see division A. And we have division B. Okay, and sale value. I'll see, maybe we have the transfer price also. So 8,000 ke liye, if you will see, they have two actually revenue. One is external sale. And the other one is what? Internal sale. Internal, this one. So they have external sale of what? Rupees 8,000. They are selling outside unit, outside the organization. Internally, they are transferring 8,000 units. All right. These are the two transfer happening here. Okay. What is the cost? The cost for them is, this is the cost for them. And it will give the profit. Okay. So 4,000 profit is coming here. You can solve and you can see 4,000 profit is coming here. Say yes or no. 4,000 profit is coming here. All right. Okay. Now let's do the calculation for the division B. Let's do the calculation for division B. Okay. I hope it is not freeze. Okay. If it was freeze, let me repeat it again. You can see sale, they have internal sale and external sale, right? Externally, they are transferring the goods at 8,000. Internally, they are transferring the goods at 8,000. Internally, on the basis of market price, you have the transfer price. Transfer price on the basis of market value, you are transferring the goods. This is mentioned in the question that you are transferring the goods on the basis of market price. It is given in the question. All right. Okay. So this is the revenue for division A, but it will become the cost for division B. So transfer price will become cost for them. How much? It is the cost for them. Achha, their own cost is what? Rupees 10,000 was their own department cost. Okay. Okay, and they're selling the final units at what price? 24,000. You will see the profitability at 6,000. And total, if you want, you can calculate the total also. Externally, we are selling these 24,000 units, plus externally, we are selling 8,000 units. These are the two external sale. The company have, overall, the company have these two external sale. The company have overall these two external sales. Achha, what are the total costs the company is incurring? So you can see in division A, the company's total cost is 12,000. And in division B, the company's total cost is how much? I think it is 10,000, the total cost. Right? These are the total cost of the divisions, A and B. You can see the profitability here. Calculator. $32 will be the sale value. 32. 22 is the cost. 10,000 will be profit. I don't need it calculator now. Okay, rupees, I've done it. 10,000. You can see the total profit is coming as 10,000. 10,000. You can see, we will just see the external sale value. Internal transfer pricing will not be considered here. External sale will be considered here. So here it is coming as 32,000. Why is it coming 32,000? Because 8,000 is the external sale. And this 24,000 is already also external sale. Internally, 8,000 unit is transfer, which is not considered here, which will be happening internally. So this is how you have to find it. All right, this is how we will solve it. If you have any doubt, please ask me your doubt. Okay, so there is a question. Overall profitability can be changed when we pay the bonus, overall profitability can be changed. We will not consider that here. We are not considering that, right? Yes, I understand it will be changed, right? We are not considering it here. Okay, you have a question from the last, you have a doubt from last question. What was that? Okay, so it was a doubt related to third one, right? What was your doubt? Give me 1 minute. Third case, Department G will be their excess capacity. Transfer will be marginal cost. Yes, dear, that I understand. But if you will see here, marginal cost, if the transfer will be marginal cost, they are recovering their minimum expectation. So they are not earning more than their minimum expectation. So they are not happy. I mean, they are just recovering whatever they have desired, not more than that. But R will be happy because if you transfer the goods at minimum, see, actually, if you will see negotiation, this is the minimum price he is agreeing at. Actually, if you will see, in case of negotiation, you get the maximum price which R is willing to pay and minimum price which G wants to recover. So negotiation happened between them. If the price will be high than the minimum one, G will be happy. If the price will be less, then this one will be happy, right? If you get a range here, right? So if it will be only minimum, then this person will be happy. Okay, who negotiated more here? R negotiated more here. R will have, R will be more happy here. All right, okay. So if you have any other more doubts, you can ask me. I hope that it is logically very clear. Logically, it's all very clear. It's so simple, right? Transfer pricing is such a simple concept to understand. Not at all difficult, not at all a rocket science. Okay. So now what do we have here? Transfer price we have done. Acha. Let's talk about the decision, conclusion they have made. Let's read the conclusion they have made. Okay, so transfer, what is given here? Transfer sales of profit center A are self-canceling the transfer cost. We know, okay, this is not affecting the overall profitability. We know that. Consequences, profit center A earn the same profit on the transfer as on external sale. Okay, we know that because the sale price is same in both the cases. Selling price is same in both the cases. So profit will be same from both the cases. A commercial price must be paid by profit center B for the transferred good, and both divisions will have their profit in a fair way. Okay, then profit center of A will be indifferent about selling externally or transfer the goods A. Because why? Because see, the point is that here what is happening, you can see that in both the cases, the transfer price is same. Where is the scenario? I have removed. Okay. So if you will see here, the company have the option, division A had the option, they can sell it. They can sell the goods to the market and they can transfer it to internally. Half of the goods they are selling outside and half of the units they are transferring inside. Point is that here it is 8,000 matlab market price mein they are transferring, and here also they are transferring the goods on the basis of market price. In both the cases it is market price. So this person is indifferent in both the cases. Here also he is recovering the same revenue, here also he is recovering the same revenue. So it's okay whether he whether he transfer half of the unit internally or full unit internally, that's okay. He is indifferent to this. Okay, so yes, this is, they have written that the division A manager is indifferent whether transfer complete unit internally, whether half of the unit is transferred, whatever the number of unit you are transferring internally, he is indifferent because he is recovering the market price, right? He is recovering the market price. This is what they have written. Okay. So he is what? Indifferent. He is indifferent. Because in both the cases, chahe external, chahe internal, in both the cases, he is recovering the market price for their product. So he is indifferent, जहाँ पे भी transfer कराना है. But yes, he is working in full capacity. है ना? Whatever the units he is producing, he has transferred it outside, and the remaining capacity is used for internal transfer. So he is using his entire capacity. ठीक है? Okay. That's it. 49. We have time. Let's do some more questions. Okay, I'll be taking a small question. Okay, let's do one thing. Let's take this one. This looks small. I don't know it's small or not, but we have 10 minutes, so let's cover this question. I expect all of you to read the question. I'll give you time, read it. If you manage to complete it today, we will do it. Otherwise, we will take it in next session. Okay? Let's try to solve it. So, read the question. Read it, take your time and read it. Yes, I hope you have done the reading of the question. Okay, let's discuss the question. What is the question? So Mariani Limited has two divisions, Division A and Division B. Division A produces product Z, which it sells to external market. Oh, so whatever the units they are producing, they are selling it external market. And also they are transferring it to Division B. Okay. Division in Mary Annie Limited are treated as a profit center. Achha, they're treating themselves as a profit center. And divisions are giving autonomy to set transfer pricing. Achha, you are allowing them to set the transfer pricing. It will be a question of negotiation because they are setting themselves. Okay. They have not given you the rule of deciding the transfer price here. Okay. Now then, and to choose the supplier. They have the option to choose the supplier and to decide the transfer price among themselves. Then performance of each division measured on the basis of target price given to each period. Division A can produce 1 lakh units of product Z at full capacity. Okay, they are producing 1 lakh units and they are producing it in full capacity. Division of product Z in the external market is for 70,000 unit only at a selling price of rupees 2,500 per unit. Okay. External market selling price is given. To produce product Z, Division A has to incur a variable cost is given. Ab dekho, agar you will not make a diagram the way I prepare a diagram, how difficult it is to understand what they are speaking here. So difficult to understand everything, right? As a working capital is financed by cash credit facility and it is given here. Division A is given profit target of this much. Division B has found two other supplier R and S who are agreed to supply product Z, product B. ठीक है, चलो अब देखो, it is difficult to understand it. The way it is all written now, it is so difficult to understand. And I told you, it is so important to understand the question first. If the question will not be clear, you can't write the answer. You cannot solve it, right? Point is that first try to understand the question. How to understand it, right? First is to focus on understanding the question. If the question will be clear, you can see the answer is not a big deal, right? It's not a big deal to write the answer. Okay. Okay, now let's try to understand it. Let's focus on understanding the question. Okay. So you can see here we have two division, division A, and we have a division B. Okay. So first line is clear. A company have two division, division A and B. Then Division A produce product Z which it sell to external market and division B. Achha. So right now what is happening? They are producing a product Z and they are selling it external market. They are selling it in market and they are transferring it internally also. They have the option, right? They can sell it in the market as well as they have the option to transfer it internally. Okay, then what else we have? Division in the Mariani Limited are treated as profit center. Achha, they are treating as a profit center. Division are given autonomy to set the transfer price and choose the supplier. Chalo, itna ho gaya, right? It is clear. Achha, I'm not deleting because the point is that we will discuss it later. This is we have done. Okay, now again. The performance of each division measures on the basis of target profit given to each period. Division A can produce 1 lakh unit of Z at full capacity. What is given here? The maximum unit which they can produce here is 1 lakh units. The maximum unit they can produce here is 1 lakh units. Okay. And the demand of product Z in the external market is 70,000 only. Acha, here demand is what? You can see when you prepare a diagram in this way, now how easy it is to understand. Otherwise, it was so difficult to understand. When we have done just a plain reading, it was so difficult to understand what they are speaking. But if you will make a diagram in this way, it is so easy to understand. What is the external demand? 70,000. That means I can say they have spare capacity for 30,000 units. What is happening here? They have spare capacity for 30,000 units. And this is given here. Okay. What else we have here? Externally, they are selling the goods at rupees 2,500 per unit. This is the sale price, external sale price. Then to produce product Z, division A incurs 1,600 variable cost. Okay, variable cost is given as rupees 1,600. Achha, what else? The total fixed cost is given and the division A employee working capital is given and the rate at which they have taken the working capital is given here. Division A has been given a profit target to earn. Okay, so they have given a profit target to earn this much profit. Okay. Division B has found two other supplier R and S. अब देखो यहाँ पे इसके पास भी ऑप्शन है. If ये बहुत ज्यादा प्राइस चार्ज करेगा तो what will happen? Division B will go to some other supplier. So division B के पास भी option है. Division B has option to go to supplier R or he has the option to go to supplier S. So he has R and S, two different supplier outside the market. चलो ठीक है. Who agree to supply the Z, जो बाहर से supply कर सकते हैं, right? Division B requested to quote the selling price for 40,000 unit to division A. I can see something here. See, the point is that they have the spare capacity for 30,000 units. But actually, if you will see, the other division is demanding how much? The other demand, this division B is actually demanding 40,000 units. So you can say, ma'am, if the negotiation will happen, minimum price for 30,000 units, their expectation will be just to recover the variable cost. Because khali बैठे, when you have the spare capacity, जब तुम खाली बैठे हो, your expectation is just to recover the variable cost, not beyond that. This is the minimum expectation. Okay. But the point is that, ma'am, what about the remaining 10,000 units? For remaining 10,000 unit, we are selling it in the market, right? So, ma'am, for remaining 10,000 unit, we have to interrupt the outside sale, and then we can transfer the goods internally, right? For remaining 10,000 unit, we want to recover variable cost plus if we are recovering the fixed cost plus if we are recovering the profitability. We want to recover everything for the remaining 10,000, but for 30,000, okay, variable cost is okay. So in this way, they will decide the transfer price considering everything. So if you will see, answer will not end up with just variable cost, which is 1,600. What do we have to do here? You will see here they have some fixed cost. They have some working capital. Usme bhi opportunity cost. We will consider that. What profit they want to earn, we consider these three things. Accordingly, we will decide the selling price, transfer price. The minimum transfer price. So what is the question? Calculate the transfer price per unit of Z that division A should quote in order to meet the target price, target profit for the year. So you will see what will be the minimum price they will set for their division A here. Okay, so this is something the question is all about. Now think about it. I'll give you time. Do it at your own. In next session, we will discuss the solution of this, right? You have to find out the transfer price. I have already given you a hint. For 30,000, variable cost is okay, but remaining 10,000, you have to interruption the production and the sale of outside. Okay. So for that, variable cost will not be the transfer price. So accordingly, you have to decide it. We will discuss this question in next session. All right. So with this, I am just winding up the session. So take care, all of you. Have a nice day.